and it's similar to COVID in the sense that it's sort of a black box. Nobody knows. We know a disturbance is happening economically. We know that disturbance is going to have a real financial cost to it. It is impossible to determine the magnitude of it. Here's what I know. The current backdrop without the tariff situation didn't justify asset prices here. With the tariff situation, it's kind of one of those deals where you're going, are you guys insane?
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots, and I am joined as always by the brain trust himself, Mr. Chase Taylor. It's really funny or interesting or whatever you want to call it. This market is behaving as if it's waiting to see what happens. Like it's a mystery. Meanwhile, Rome's burning. Right? And it's really odd to watch. I hate calling up COVID. It's just hard to think of any other parallels where you're like, we've seen markets do it is behaving as if it's waiting to see which way it goes, right? But it's already going.
Yeah. I mean, the ships have stopped sailing.
Yeah.
So yeah, it's happening. The supply shock dynamics are similar, except this time, you're not going to get, the
$8 trillion.
Exactly. That's exactly where I was going with that. Right.
Yeah.
Now we will have to add some liquidity if this gets weird, and it's probably going to get weird. So we probably will add liquidity, but it's not going to be like that where it's like, oh, we'll pay you more to sit on the couch than to work and all that stuff that made some sense because of what happened there where no one could go to work. And this is just so different. You're not going to get the same kind of all of government approach to stimulating, demand. So,
yeah. And in that route, I mean, we've seen some really crazy stuff over the last, 5 years or so. In that route, I think this might be one of the most confounding environments I've seen. Like just watching a market refuse to price in the really bad stuff that is happening right now even to individual companies, sure. Right? Like this little run you're getting in Tesla, it's hilarious to me. Apple, same thing. You're just sitting there going, what? Look, nobody knows the short-term direction of an individual stock, but what is your thesis here? At those valuations, at these levels, it's kind of a mind blower. And like you said, it's really odd because this is exactly what you would expect from a market that was waiting to see what happened in a certain, right? Sure. It's happening. Like you said it guys, earnings are going to be bad, right? The question is how bad and how deep and how long does it go, right? The market now not even responding to Trump, like you said, Bessent's tone, we had a dovish tone. Apparently everybody was talking about that a week ago.
Right, we sounded like we were backing down with China.
Yes. Bessent's out there again today, which he was sent out there by Trump to say it, that no, China's going to have to act first.
Yeah, you back down first.
They're not going to.
No, this is where history gets real important. You go back and read about the century of humiliation, the fact that they felt like the West totally subjugated them and humiliated them for 100 years. Given that history and that backdrop, I mean, that's kind of no kidding, the birth of the Communist Party was to never let that kind of stuff happen again.
Yeah.
You think this guy's going to just back down?
Well, and you see videos they put out today.
No.
Did you see the video that the Chinese government put out today? I'm pretty sure it was the Chinese government. I saw it on social media, so it might not be. But it was a flat out shot, and they were developed country, and they showed pictures and video of our subway system, and then they said developing country and showed pictures of theirs and videos of theirs.
That's not wrong.
No. That's not wrong at all.
It's unfortunate.
Yeah, that one part of it. But they again.
They seem to be relishing it.
They're not going to back down anytime
Right.
soon. Like they're not now. Do they have a lot to lose? Yes, they've got a lot
100%.
to lose too. They've got a lot on the deal. But it's another one of those moments where you're looking at this market, a price discovery mechanism, or supposed to be, and you're going, okay. What do you make of that? Do you think this is just, is this just mechanistic, or is this yet another example? And you know, you and I have talked about this a lot. I still haven't come up with a reason for it. I mean, you can get into behavioral stuff. You can get into, you know, high frequency trading. You can do whatever it is. We have watched consistently how this market refuses to price in, especially anything bad, even when that thing is inevitable right in front of it. And it doesn't price it in till it hits, right? It's almost like a fighter jet that never gives you a radar lock alarm. You know what I mean? The do, right? It's just like you're just flying along, the sun's shining, blue clouds, boom, you're dead, right? It's just bizarre, especially something that should be incorporating all of the data in real time.
Right.
And it's just not at all. It's just not at all.
Yeah. There's two ways I could square it. One, the market and its collective wisdom just believes like they'll back down so much so soon that it won't matter. But I think more to the point though, like if you really look into the data, the humans really are the ones that haven't sold. So the machines sold because their rules told them they had to, and then Europeans took some money home. That's it. So if you look at retail, they've bought essentially, not sold. And if you look at like obviously like pod shops had to degross because they use a lot of leverage, but your average active shop, they did sell some, no doubt, and they hedged, and so like not crazy bullish the way they were, but your average active shop isn't, you know, sitting on an enormous pile of cash or anything. They actually have a lot still invested. And I've seen two charts in the last 2 weeks, one that shows this with retail and one that shows like this with professionals. And it basically shows the difference between their sentiment and what they're actually doing. And the sentiment is just, I fell off a cliff. But then you show like, well, what have they done about it? They've barely sold. And that's both professionals and retail. So I think that kind of shows you where you're at, where the machines sold, they're out. They haven't really started to get back in, which does make me feel like, okay, you can actually keep rallying for a little while. Yeah. But you know, all the people that can read the news and look at this and go, maybe I should sell some stuff, are the ones actually not. Whereas the machines have, you know, the Vol Control Fund doesn't know what a tariff is. It just knows that Vol got weird and I have to get out. You know, it's perverse and backwards with who's being responsible and who's not. It's interesting.
Yeah, it's again, it's yet another example, and you know, there's tons of inputs for why markets, you know, do what they do, and to try to, you know, pinpoint it on any given day or even over one event, right? There's just, like we've said, there's so many different drivers in markets, but yeah, it's very incredible. You know, we've seen this before. Well, more recently, it was sort of like the last quarter that so not this quarter, but the last quarter Tesla announced, you know, two
in a row,
disaster quarters in a row. And then the first one, last quarter, the stock rallied, right? Remember off that? And we went
very nicely. Yep.
Yeah. And we went, all right, we're shorting it. Right. I feel like the entire market, not the entire, there's stuff that's beat down, but I feel like the whole market is sort of behaving like that.
And Mag 7 had, well, I mean, granted, you expect this if it's a bear market rally, right? But Mag 7 last week, it was its best week in about 2 years.
Yeah.
So,
yeah. Which is nuts.
Given the backdrop. Now, the backdrop
did
get less
where
bad,
they're valued. And where they're valued. Yeah, but you that's like saying it got less bad, right? But that's like saying instead of getting hit by 20 nuclear missiles, we're going to get hit by 15.
Yeah, and that's I think that captures it. Is we're so whipsawed with headlines and social media posts policy that everyone has just zoomed in on that, and it's just the rate of change of policy is what matters to investors, not policy. It's only the rate of change of it. So if it's trending in the right direction, it's like buy it back. If it's trending in the wrong direction, ignore it for the first week apparently, and then maybe get, I don't know, because that's been the weirdest part to me, is that late last week we started to flip back around to like being less this is going to end soon, and even the stuff that we're being told is going great, Japan, Korea, and everything. Like Korea came out today and they're like, well, we're not actually going to do anything until after our election in June. Oh, okay.
Yep.
Like looking at the calendar, like that's not good.
Yeah.
And every time one of these players does that, and Japan's not in a hurry, every time one of these players does that, it gives more incentive for the other players to be like, yeah, we're not in a rush either, know? So especially as we're going to start feeling the heat with prices and store shelves. And I mean, we're already seeing it politically. There whatever, like 3 weeks ago, there were some protests, not huge, but some protests around the country. Obviously the representatives having the town halls, those are getting spicy. Maybe that's not grassroots. It's fake or half grassroots. But you look at the comment section on, well, anything these days. I mean, people are starting to push back, and it's becoming a political problem for some people. And this is before, I mean, in real life, we haven't felt the effects of this, right? Like,
no, not yet.
Yeah. I haven't gone to buy something and it wasn't there. I haven't gone to buy something like, whoa, it tripled in price. Like none of that's happened, but some of that stuff's going to happen. So like people don't even have a real reason to be mad yet. No one's lost their job. Like,
yeah.
So if people are getting mad before this stuff hits, then where are we in 6 weeks? I don't know.
Yeah. I mean, and like I said, then you look at the stock market and it tells you there's absolutely nothing wrong. And here's the other thing, and we brought this up before, but all of this, in my opinion, misses the fact that before all this started, you weren't trending the right direction. It wasn't bad, but it was slowing. You were slowing, right? And it all sort of makes sense. Like, meaning, we knew that we would have a recession or an economic slowdown, earnings, something of that sort, when the sugar high from COVID wore off, right? Like, and I don't think that that's a controversial statement at all, right? Like there was going to be some type of hangover, whether it turned into a proper recession or not.
Right, could be just 5% growth back to 2-ish, and then
yep.
Just no more sugar high, because we still got a lot of sugar and just the deficit. But
there is, but so then you apply that backdrop to what we've currently. It's again, I hate using the same analogy over and over and over, but the only comp I've got to it is COVID, where you're going, look, I guess I could be wrong. I don't really see how. I know that this is, and it's similar to COVID in the sense that it's sort of a black box. Nobody knows. We know a disturbance is happening economically. We know that disturbance is going to have real financial costs to it. It is impossible to determine the magnitude of it. Here's what I know. The current backdrop without the tariff situation didn't justify asset prices here. With the tariff situation, it's kind of one of those deals where you're going, are you guys insane? What are you expecting here? Like, you're trying to push multiples back to by the highs, the whole, it was sitting at sequential highs, but you were, coming into this year, you were right at, I think we were a little bit higher at the end of 2021, but right at the highest valuations we've seen in this entire cycle.
Yeah, I mean, it's close enough to the insanity of 21. Yeah,
and on nothing, right? And for all the Trump supporters out there that they're, oh, well, Trump's going to be great. Like, look, I think, and I am hopeful that the things that he is doing will be beneficial long run for the economy. Okay, but trying to equate this time, him coming into office, to the backdrops could not be different, right? He had levers he could pull back then, like corporate tax cut. You know what I mean? There was all these kinds of things. he was effectively increasing stimulus when
It was pro-cyclical stimulus for the first time
Right.
in decades.
Right.
Yeah.
Right. And you look at what's happening today and see the exact opposite. You know, it was like you and I were laughing about how the immediate aftermath of Trump, you saw small caps run again, just like they did in 2016. And you're going, guys, that playbook ain't going to work this time, man. I mean, let's just start with rates, for God's sake, right? We were still in ZERP in 2016 when he got elected last time. It's a completely different ballgame.
Yeah, in 2016, people literally didn't think we could get inflation no matter what we tried.
Yeah. Yeah.
People like smart economists would have looked you in the eye and been like, you can hand everybody $1,000 or $1 million right now and there still won't be inflation. Like people would have made the argument.
Yeah. Yeah. There were people trying to make that argument.
And now we've been above target for 3 years, 4 years.
Yeah.
So
yeah, it'll never happen. Right. Yeah. Famous last words. Why don't you give us a little rundown on the indexes? I mean, we were basically flat across the board, weren't we?
Yeah. But with some intraday vol, I mean, we ranged from like up 1% to down 1% to close flat. So kind of interesting. But yeah, S&P closed up 0.06, Q's down 0.03, small caps up 0.4, equal weight up 0.3. So those were decent with Mag 7 down 0.4. Ex-US today was up 0.58. So back to some small outperformance from the rest of the world today. Oil was down about 1.8. Good day for metals. Gold up about 1.8. The rest of the metals were green as well.
That rally in gold kind of caught me.
And even gold was like kind of all over the place intraday too.
Yeah.
So like the intra-period vol was kind of big. The dollar, this is notable to me. I mean, we were up at one point on the dollar a little bit, decent amount, and then we closed down 0.65. So that dollar weakness is back. And, you know, we did see at one point up decent on the day and closed flat. So maybe it's more of the capital outflow story if the dollar's going to give that much up. Although on the bond side, bonds seem like they were sniffing recession to me. Like 2-year down 7 basis points today. And even the long end, like the 10-year is down 5. And that's maybe notable given, I mean, over the weekend, President Trump talking about, we can probably get rid of the income tax for everyone under 200K, replace it with tariff income. I thought the bond market would be upset about that. And I thought we'd be up 5 basis points, but we were down. So maybe the inflation impulse to bonds is starting to be felt. Sorry, the recession impulse.
You know, we're I wouldn't say we're defensively positioned. Yeah, we're moderately defensively positioned, but
with some right tail like hedges,
yeah,
you could say.
Yeah.
In case.
But I will say this. This feels I keep thinking about one thing over and over in my mind when thinking about this market, and that thought is sell the rips. I don't really I'm with you. I think on a lot of the same reasons. On a technical basis, definitely looks like you could bounce here. I'll tell you what, I do think this though. If we weren't up 6% plus on the year, it's very hard for me to believe that we wouldn't be more defensively positioned than we are now. You know what I mean? Like I feel like we've got some leash to,
right.
You know, to kind of play some of these trades, play for a bounce, that kind of thing. But it feels like, again, until something changes underneath the surface, meaningfully, right? Whether there's more news, more, you know, a trade deal announced, something, it just feels like if you're in this environment where people want to run it, to me, that this is an environment where you know, get nimble, right? Spread that, you know, my old analogy about, you know, if you're on thin ice, you know, spread out, lay down and spread your weight out as much as you can. You know, take advantage of opportunities, but I think you sell rips here. You know, if you want to tactically pick them up on the dips and try to play for a bounce, sure. This just, it's very hard looking at this backdrop, not envisioning a scenario in the next 6 to 12 months where at the very least, you're not going to have a much better opportunity to buy these names at significantly lower prices.
I mean, if policy stays where it is today, we absolutely should get the opportunity to buy things at better prices.
Yep. But that's one of the
domestically anyway.
Yeah. But that's one of but again, you know, like here in the US, it's one of the things that, again pulls me to the unloved names, the names that aren't caught up in the indexes, right? The names that aren't Meg 7, because you look at so many of those names, they have not fared as well. And if your thesis is this is going to play out better, I still don't think Meg 7's where you want to be. Now,
I think Mag 7's. I hate saying this. Some of Mag 7 at least is better as a hedge if this goes the worst way, and the biggest reason is that dollar angle. Like if the dollar keeps going down, their overseas earnings, at least they have that.
Yeah, and when I say Meg 7, I'm talking about the totality, right? Do I want to be in all of Meg 7 right now? No, I do not.
I don't want to be in all of them in any circumstance whatsoever.
No,
but I don't want the weird 3.
Yeah, but like you said, the flip side is there is the other 4 that I understand why people don't want to sell those.
Right.
Now, we're holding pretty light positions overall. We've got one that we've weighted up a little bit more. It's a short-term trade with the idea that we can add to it. Because again, even those, you don't want to go long and strong. I mean, in this environment.
Yeah, I don't want to be long and strong really much of anything in this environment.
Yeah, nimble is kind of the way that I feel about it. But getting back to gold, that surprised me, that move today.
It actually looks a lot like Bitcoin, and it's starting to create a very short term kind of like rectangle. I'm still in it. So to me, at least short term, you kind of just use that to see like, what are we going to do here? Like, what are you really up to?
Mm-hmm.
Now what it'll probably do is break either higher and then it'll be fake, or break lower and be fake, but we'll see. I definitely think it's going to be fine, medium term. I still have some concerns short term, but I really want to see all that positioning and sentiment data stuff to see if we just need that stuff to get reset more than we have in the last 6 months.
Yeah. The another one that's kind of odd to me is I'm hearing guys I respect and listen to talking about a quote unquote breakout in Bitcoin. I'm looking at the chart and it was a bit of a head scratcher to me because I'm going.
I would call it a breakout.
Would you?
It's above its kind of diagonal downtrend line that persisted for a while, kind of like a big bull flag. And there's some horizontal lines that it's recaptured.
It's just weird to call it. It's weird for me to call it a breakout when you're about 12% off the all-time high.
To me, a breakout just means breaking from a
short-term trend.
Yeah, it could be a short-term trend or a consolidation. You know me, my favorite one is something that has died and then gone sideways as roadkill for 2 or 3 years and then breaks above that. That's the best breakout in the world.
Oh, for sure.
Which we're seeing right now in some of the some stuff in the ag space, like some of the fertilizer companies that we are touching gently here.
Well, one of the other things too that's going to be interesting to see is that if you look at the last 10, 12 years, probably the most underperforming sector, generally speaking, in the global financial system has been like real assets, right? Whether 100%. Metals, commodities, ag,
timberland, you name it.
Yep. One of the other interesting things, and the way markets work has always fascinated me. What's funny is those names are, like you said, we see some positive things, but judging by if you're judging by the rest of the market is still very unimpressed with those names, right? And the thing that I think is really interesting is it's set up a scenario where it's created very attractive valuations on a lot of that stuff.
100%. But
also, I kind of feel like people are whistling past the graveyard on this one a little bit, meaning in a more competitive, not as collaborative environment, those real assets become more important.
Yeah, exactly. I mean, like you can't tariff a farm.
Right.
Well, I mean, kind of can, but
yeah.
Well, but you can't.
Yeah.
Like, who cares about global trade for owning some super just basic stuff like dirt and chunks of metal and like and not to mention like the best time to own real assets is when you're in an inflationary backdrop, when you look around the world and you can't really find anyone that seems to want fiscal responsibility or a strong currency. I mean, we're in that environment. Like,
yep.
Try to find someone that's, really serious about fiscal and about monetary policy and about keeping the currency strong. That's not a thing. That's a good time to own real stuff.
Yeah. You know, another funny thing about what you just said, it reminded me of is the other thing that has me convinced that that's the kind of the right place you want to be is I don't think in any other environment you'd have the run in gold that you've had and have less people talking about it. Now, the trade got crowded there momentarily, right? People got overpositioned, but I'm talking about like Reddit threads and retail money, right? There has not been hot retail money flowing into gold miners or gold.
Definitely gold miners, yeah.
Yeah. And
except for in China.
Okay, well, yeah, except for China.
Man, they're buying gold hand over fist.
I just think about in normal times. That's a weird turn of phrase. But in more traditionally normal environments, when you had a run like this in gold, everybody'd be talking about it. You know what I mean?
I think that's largely over. Yeah.
Yeah. It's
which is great.
Yes. Yeah. It makes me feel much more comfortable. Right. And the eyes are all turning to Bitcoin and the Mag 7s again and all that kind of stuff. And I feel like gold is sort of one of those. Well, I think a lot of commodities are for whatever reason. It's kind of like that. If you stare at it, it's not going to do anything. It's when no one's looking at it, that's when it wants to run.
Right.
You know what I mean? Like, what is that? What is it? What is that thing in physics where it's
if it's observed, it changes.
That baseline of quantum physics. But no, it definitely feels like that environment. What else did you see today? What else caught your eye?
So just one thing before I go there is on the market huddle. I think I got a question about silver, and one of my concerns is like people always like, oh, this is where the speculative money will hit silver now, and it's like the speculative money is buying dog with hat, not like I don't think they're coming for silver. So that's exactly to your point. Today, so this is a massive week for data. Like my data thing, like I could barely fit the week's data on my chart that I normally can easily fit it on.
That's got you all ginned up.
But today was only one, which means the next 4 days is just absurd amount of stuff. And the one we had today was the Dallas Fed's manufacturing survey, which was expected to come in at -17, and it came in at -38. So that thing wasn't cute. And some of the insides of it were even worse. First of all, the comment section it's been this way for a couple of months, but it's bad. But one of my favorite things to look at in all these is if you take the new orders index and then you subtract out inventories, because that gives you a good feel for where you're heading and not just where you're at today. And it's only been worse in COVID and in the GFC. So that kind of gives you a good thing, a good feel for where normal manufacturing companies are. And a lot of these aren't big publicly traded companies. These are, the no kidding lifeblood of the economy at the end of the day. So to see that, it's alarming. And we'll get their services tomorrow, and we'll get some more of the, some more regional stuff throughout the week. But those are bad. Even
those are sort of catching my eye, and or kind of blowing my mind. And a bit of it's understandable because in so many of those surveys, you'll get a one-off bad data print that people will overreact to, sure. or more important, or more aptly, I think people just kind of start muting them, right? They don't really pay attention. Oh, it's one-off. They've all been bad.
Yeah.
Okay. When they're all bad, I've never seen them all be, but well, like you said, you're watching something that only happened in COVID in 2008. When they're all bad like this, guys, it's not a bad print, right? Bad stuff is going on right now. And that's where it's really hard for me to wrap my head around a longer term bullish feel, because, I was going to ask you, what is even the long thesis here? Because any type of resolution here, it isn't going to be a 24-hour thing. You know what I mean? Like,
no, but the market, if the announcement came out today, hey, the trade wars, we're turning the whole thing off. We're going to do 10% tariffs on everybody. It's over. Forget about it. At that point, even if you're like, well, it's going to rip. There's going to be like a bottleneck for trade, because there still would be, and that will create some problems. But like the market would be like, okay, bro, who cares?
Oh yeah,
we're going up because it's over. Yeah. So, but the thing is though, like that is other than that, I don't know what your bull case could be.
Well, and I don't think, look, Trump can turn on a dime.
Clearly,
We all know that. And you can't discount that.
But will he with the market up here?
I don't think so.
Exactly.
No, I don't think so. And he doesn't have a need to. I mean, yields are starting to go with him.
Right.
The
worst thing that could really happen is for market to give him some faith that this is fine.
Yeah.
So I feel like the market rallying is kind of the worst thing that could happen for the economy over the next year or two.
Yeah. And yeah, it's really hard for me to look at this market and it's one of those moments where you're like, what movie are you guys watching? I want to watch it. I just can't dial it up, man. I'm not seeing it. What else do we have to discuss? I not much. We're kind of stuck in this limbo where any news you get, all of it pales in comparison to, right? Like there's just, you know what I'm saying? You've got
even the data, like,
yeah,
because all the soft data no one cares about anyway.
Yep. And
the hard data, you're still getting the front running, feeding the hard data for another month or so. So that's not going to be bad yet. So it's we're in like a weird purgatory where there's no amount of good or bad data in the next month that will, other than employment, that will really move the market in a real way. I don't think, because most of it, the market will be like, well, I knew that,
yeah.
And except for employment, but even employment, like it should honestly be fine Friday, because none of this stuff had hit by the time, that data was collected.
Yeah. And I haven't been worried about a big market drop. A little bit of concern is starting to pop up, and here's why. Now, look, I'm not saying I think this. I'm not at all saying I think this is going to happen, and I'm not saying I think it's an odds-on favorite to happen. But you were talking about something I've been thinking a lot about. You got to keep in mind that we still have record retail involvement in this market, right? The one thing that's starting to come into my purview a little bit in terms of being more open to a bigger drop is I kind of feel like you've got a scenario right now where retail is really the only group running headlong into this. And I feel like a lot of pros have put in defense on, and they've got some backstops. And I think it creates a scenario where, under the right or wrong conditions, depending on how you're looking at it, that you could get a really violent hard down move where all of a sudden the reality that the market is ignoring, and in this case, my feeling is that it's almost mostly retail that's ignoring that, where all of a sudden reality comes hard and fast.
If you get retail to capitulate, it would be ugly.
Yeah,
that's for sure. To me, what I see as the biggest risk of like a crashy kind of risk would be is we do just keep taking the stairs up for another month or two, say to get up to like that close to 6,000 ish, despite the fact that nothing has changed, and maybe it emboldens them to like really hold firm on this policy, because in that one you get systematic to get back in, and that getting systematic, getting long, that's when it starts scaring me about like the nasty like 5-8% kind of days,
Yep.
So if we do get that awkward 10% up from here, getting systematic largely back in the market, let's just call it a half of normal, like that, and on the back end what's coming with economic reality, like that would be a very, very risky moment.
Yeah.
But the beauty of that is if you get that, you get vol back down, you get better levels to kind of hedge from. But that would be sketchy.
Yeah.
And at the moment, it feels like that is not a 3% chance of happening.
No, I mean that's what I'm saying. Again, I hate to keep saying it. It's just it feels like you're rolling into COVID, where you're sitting there going, when, like, kind of sitting back, chewing on your fingernails, kind of peeking out over the screen, going, when are they going to figure out what's coming down the road? You know what I mean? Because it feels like one of those moments where everybody's going to realize it really fast.
Yeah, and I think a lot of this too, it feels to me kind of like people are going off the vibes and what people are saying instead of like what's
the data.
Right. Like, yes, they said that they, this was unsustainable and that there would be negotiations with China, and they're saying we're talking. All that's true. But at the end of the day, look at the tariff level and, oh, it's still triple digits.
Oh yeah,
Like-
well then that's why I brought up that video that China put out. Like I'm sitting there going, hey guys, nobody is postured for quick resolution here.
Right.
Like I don't know what you're looking at. I'm watching both sides digging in.
Yeah, to me, you got to engineer a way for both sides to step down at the same exact moment where no one's bowing. And it's just,
No one.
yeah.
Yep. But you know, again, like I said, we'll have to judge this at its finish to figure out whether it's effective or not. But what I will say is that it's getting increasingly dicey day to day, and you know, we were equating it earlier. Our company meeting we had this morning, I was equating it to one of our employees. I was like, you know, think of it sort of like a fire, right? Like the longer it goes, the more stuff is getting burned. And I don't think what people are paying attention to is their attitude is like, is somebody going to light the fire? And you're like, guys, it's burning. It's burning right now. Earnings are going up in smoke. GDP is going up in smoke right now.
And speaking of earnings, I do think that is one area where, and the start of this move down, I think the origin of it was actually Walmart and their guidance, because they were like warned, like, hey, this can get weird, and the market did not like that. So I think having one of the key players in the S&P come out with some nasty earnings revisions, guidance lower, pulling guidance, whatever it is, that could be a thing that shakes the market again. Like that could even be the thing that snaps and causes the next leg lower. I mean, I don't know who, but just pick somebody from the top 30 there. Maybe Costco. Costco comes out and like, hey, those earnings we said we're going to have actually going to be negative. Here's where we think our margins are going to. Like, we're going to have to lay off warehousing staff. Like, here's an event like that, and people would be like, I'm sorry, what?
No, but here's the
even though it's kind of obvious that it's going to go that way.
Here's the awkward part. So what happens to Costco in the next recession? If their earnings get hammered and Costco really gets beat up, do they fall all the way down to 30 times earnings? You're in such a weird spot with so many of these companies.
And they may be able to make it up on volume because people are going there to save money. So maybe that's a bad example, but
no, well,
you get the point.
No, they're not going to make it up on volume in any way close to justifying their current multiple.
Not with that attitude.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.